we're going to talk about long-term, long-lived assets. Plant assets are tangible. They have physical substance to them. Physical substance, a definite size and shape. They're used in the operations of a business. So plant assets really work to help provide the service or the sales of a business. They are not intended to be sold to customers. So as far as a manufacturing company, the machinery equipment to produce the products, that's not going to be sold to the company. It's the products that are being sold to the company, okay? They're expected to provide service to the company for a number of years. So this resource or this asset or this piece of physical substance is going to be utilized for greater than 1 or 2 or 3 periods. Think of this, a plant asset would be an item that is possibly machinery. It could be an item as it relates to on an assembly line, maybe a motorized piece of equipment to separate various products. It may be a dispenser to put liquids into products, but they're basically assets that help create the products or provide the service for businesses. They're expected to provide service to the company for a number of years. Plant assets never will include land, okay? Land is something that will never be depreciated. These plant assets are usually called on the balance sheet property, plant, and equipment. And you'll sometimes hear the term fixed assets when we're dealing with plant assets. Plant assets are important to a company's success. Look here. Plant assets as a percent of total assets. Wendy's plant assets are 73% of their total assets on the books. JetBlue, 69%. Look at Walmart. Walmart's only 53%. Nordstrom's is at 39%. Microsoft is at 3%. So you can see that they vary widely based on what type of industry we're dealing with. Now, when we're dealing with financial statements, generally speaking, we always talk about the historical cost principle. Basically what that means is what you purchase something for, what your cost is in an asset is generally what you're going to record it for on the books. What does that cost consist of? It's going to consist of the purchase price of the item, all expenditures necessary to acquire an asset and make it ready for its intended use. So if you've got legal work to transfer titles, that's part of getting this asset ready. If you have to do modifications on the asset, that's part of adding to the basis or the historical cost of the asset. Any questions on that so far? Revenue expenditure, costs incurred to acquire a plant asset that are expensed immediately. Capital expenditures, costs included in a plant asset account. So basically, when we're dealing with a revenue expenditure, they're going to be items that we might have to repair a certain piece. That may be an item that we get to expense on our income statement right away. But other items to place it in service, to maybe prepare it for its intended use, modifications, would be a capital asset that we're going to add to the cost of the asset. Cost is the cash paid in a cash transaction or the cash equivalent price paid. Cash equivalent price is the fair value of the asset given up or the fair value of the asset which is received, whichever is more determinable. What does that mean? What if I am going to sell Billy my automobile, but Billy's not going to give me cash for it. Billy's going to give me salt. Billy's going to give me Billy, what are you going to give me?
Salt was a good answer.
Anyway, Billy was going to provide me with maintenance. He was going to mow my yard, which has an average cost of $50 per week for roughly 20 weeks a year for the next 5 years. Okay? So I'm giving Billy my car, and in turn, Billy is going to provide a service for me. Okay, that's not a good one because you're providing a service, you're not providing an asset. Oh, how about this one? I'm giving Billy my car, selling Billy my car. Billy, in turn, is giving me his new 0-degree radius turn Toro 60-inch lawnmower, along with the latest snow blower, and a trimmer. So, the cash equivalent price, we're not trading money, are we? We're trading assets. The cost is going to be the cash equivalent price of the fair value of the asset I'm giving up, or the fair value of the asset I'm receiving, whichever is clearly determinable. My car is a 2003 Infiniti, and the Blue Book value on it, say, is $7,000. Okay? I have a hard time telling about Billy's because his Toro is pretty cool, but the other two pieces of machinery I don't think he could get a penny for. So whichever one of these assets that we're giving up or receiving is more clearly determinable, that's what I'm going to show the value of the transaction. So sometimes we're not always dealing in cash, and we still have to come up with a historical value. Land, as we deal with showing the cost basis of land, all necessary cost incurred in making land ready for its intended use will increase the land balance. Costs typically include the purchase price, closing costs, broker's commissions, any accrued property taxes or other liens assumed by the purchaser. So let's say here that Hayes Manufacturing Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that's raised at a net cost of $6,000. Additional expenditure are the attorney's fees and the real estate broker's commission. What amount are we going to show that is the cost of this land? First piece we're going to take is $100,000. Then we're going to add the removal of the warehouse, the attorney fees, and the broker's commission to have a value, or the cost in our land is $115,000. Expenditures that are necessary to make improvements, such as driveways, parking lots, landscaping, all have limited useful lives. The land itself is not going to ever be limited. It's an unlimited useful life. That's why we can never depreciate it. But certain land improvements are going to have a limited useful life, and we may have to depreciate those aspects, such as driveways are going to have to be repaired over time, correct? Almost yearly up here. Fences break. Landscaping gets destroyed. All of those items we can depreciate, the improvements on a land, but the actual land itself will never be able to depreciate. So these improvements we're going to depreciate over their useful life, depending on what their useful life is. Buildings, again, are fixed assets. Think of this building in here. What will it cost? The purchase price are all the contractor fees to build the building, any closing costs, broker's commissions, replacing and repairing various expenses to get it up to snuff. In construction cost, it's going to be the contract price plus everything it took to build that building. The utilities while the building was being built. The insurance, everything gets added to the cost. When we talk about equipment, we are going to include costs to get it ready to function in the manner we want it to be. Purchase price, sales tax, to get it delivered here. The insurance, and then anything we do to modify it, to get it ready for use, to test it, those are all parts of adding to the historical price or the basis of this equipment to get it so we can place it in service. Lenard Company purchases a delivery truck at a cash price of $22,000. Related expenditures are sales tax of $1,320, painting and lettering $500, motor vehicle license of $80, and a 3-year accident insurance policy for $1,600. What's the cost of the delivery truck? Who wants to take the first item? What's the first thing we're going to say? $22,000. The next one. Sales tax. Painting. What else? The motor vehicle license is something you're going to have to take every year. How many of you guys have an automobile and you have to pay that every year? That's going to be an expense yearly. The 3-year accident insurance policy is going to be an expense related to revenues. It's not going to add to the cost of this asset, okay? It's going to be expensed on the income statement. Lenard Company purchases a prepare the journal entry. So this journal entry, to record all this, we're going to take the number back here of the $23,820 cost of the delivery truck to show that as equipment or delivery truck or whatever we call it. Then we're going to take a license expense of $80, an insurance policy of $1,600, what's going to cover the next 3 years. So since we haven't used it yet, it's going to be on our books as an asset, and then cash of $25,500. So do you see what we're doing? The item that relates to the equipment is shown as an asset, but then those items that are going to be expensed yearly, such as license and insurance, the license expense is going to be shown here as an expense. We paid up front our insurance for 3 years. So according to GAAP, we need to show that as an expense as it's incurred, as the timing has passed. So after year 1, we'll take a third of this and debit insurance expense, credit that prepaid insurance. Some people buy and some people lease. Why do people determine which is the best way to go?
Short run, long run.
So you think the short run or the long run? So you would believe that a lease probably is better for the short term, and then for the long term, it's better to buy. That's a good idea. Anybody else have suggestions? Anybody? You know, there are times when you just want something temporarily for whatever purpose. It might be technology. It's going to change real fast, and you know that, so you don't want to get locked into something that's going to become worthless or obsolete in the current future. Another benefit of leasing is you don't really need a lot of money up front to put down. And when you lease, unless it's a capital lease, it's just a pure expense. You don't show any assets on your books. You don't show any liabilities. It's just an expense. Now, there is something called a capital lease where that will be reported as an asset and liability on the books, even though you don't actually own it. But there's certain guidelines that we'll talk about that based on the length of your lease and based on the length of the useful life of the equipment, if it's usually 90%, then it's going to be treated as a capital lease. So in other words, it's a maneuvering of showing something as a lease, but the truth is you have control over it, over its useful life, so they require you to report it on your financial statements. Leasing's a big business for U.S. companies. In a recent year, leasing accounted for about 31% of business investment. Who does the most leasing? Major banks are big lessors. Also, many companies have established separate leasing companies. And that is interesting. Delta doesn't own their airplanes. Delta's airplanes are owned through a leasing company, and Delta leases the airplanes from the company. Depreciation. We've talked about depreciation, but now we're going to get into greater detail of what depreciation is. We take depreciation to allocate a portion of the cost of that asset over its useful life. So depreciation is really that procedure or process we do to allocate the expense, to an expense called depreciation expense, the cost of an asset over its useful life in some type of method. And we have to allocate the cost. It applies to improvements on the land, but not the land. It's going to apply to buildings and equipment. So the reason we do this is this building is going to be utilized for Augsburg to hold classes. Now, it's probably got a useful life of 49 years. How many of you have been over there to Old Main? How long do you think that's been around? At least 49 years? Is it as usable as this place? There probably need to be some improvements done on it. So do you see why we depreciate an item? So we can take a cost of that item over its useful life. And that's a perfect example of what happens after 40 years. That building needs some improvements, some updating, right? Some repairs. And so the purpose of depreciating is to take the cost of this building, what it costs to place it into service, and allocate that as an expense over its useful life. And we want to be wise to make sure we're depreciating it over the amount of time that we really can use this building. And the purpose is, ultimately over time, things break down. Things aren't in the best condition that they once were. So Billy's Toro, the Toro's decent, but what are the other two items you gave me? Oh, the snowblower. That snowblower is such a piece of junk. I mean, he's been using it for 10 years. What was I expecting? To get something shiny and new? The motors had hours and hours of service. The tines are all chewed up from the ice and the snow and the rocks he hits. Get what I'm saying? You purchase it for $2,000, but he's, let's say, used it for 7 years. Well, a portion of that cost gets used up because it doesn't work the way it works when you first got it. Now, there are items that maybe don't depreciate in value, but for the most part, a lot of the items we're going to talk about in class do depreciate, and we allocate it to the expense. Factors in computing depreciation. All costs necessary to acquire the asset and get it ready. And then we have to determine the expectancy, the life expectancy on this asset. And, that will take into account fixing it and repairing it and things like that. But how long do we really think we can keep this truck going? And then when we're done with it, you see how it starts out beautiful. You see it's starting to wear. Boy, this sucker needs to go. When we sell it to somebody, how much are we going to get for it once we sell it? Worst scenario, even though no one drives it, at least we can sell it for some of the parts. So the salvage value is what the asset's value is at the end of its useful life. So there's all kinds of methods of calculating depreciation. The simplest is straight line. And then there's some others, declining balance method and units of activity. Basically, straight line provides the same amount of depreciation year after year after year. The declining balance method assumes heavy use on that asset is going to happen in the first couple years, and it's kind of gotten used up, the asset, and so towards the end of the useful life, it's a much smaller amount. And then units of activity, basically, the asset might have a useful life of 20,000 hours. And so units of activity will be depreciating this asset on a certain measurement based on how much we use it. Okay? Make sense? How are you guys doing? Anybody? Does it smell to other people in here? Or is it just me?
It probably does. I can't smell that well.
Anyone else smell it? What does it smell like? What? It doesn't always smell this bad. I think it smells a little bit like sewage. Hate to say it.
Should we spray some like Febreze or something?
No, darling. I think it's bigger than Febreze.
Well, I got some.
Thank you so much. I'd like to light a candle, but I'd probably get in trouble, huh? So let's take Bill's Pizza. They purchased a small delivery truck on January 1st of 2012. It cost $13,000. We think its salvage value when we're all done with it is $1,000. We're expecting the useful life to be 5 years and 100,000 miles. Now what we have to do is compute depreciation based on 3 ways. We're going to base it on straight line, on units of activity, or on declining balance. So let's look at how we're going to do the straight line method. We're going to take the cost of the asset of $13,000. We're going to subtract from it its salvage value because we know we're going to get that for it, so we're going to not depreciate the salvage value. We're going to subtract the salvage value of $1,000 to come up with a depreciable cost of $12,000. We need to take that $12,000 and divide it over 5 years, which is the useful life, to come up with an expense of $2,400 each year. So for the straight line method, do you see how we are going to show depreciation of $2,400 a year for 5 years? Look what's happening as each year we continue our depreciation. We started the asset with a book value of whatever it was, 13, and we are depreciating that 12,000 down. So at the end of the period, we're left with the salvage value at 1,000. So based on what we started the depreciation, the cost at, which would have been 13,000, knowing we're ending with 1,000, each year after we add that depreciation, we're going to subtract our new book balance, our book adjusted basis, keeps going down every year as we depreciate that asset. So the journal entry we'll use to record the depreciation in 2014 is a depreciation expense of $2,400 and accumulated depreciation of $2,400. What if the delivery truck, instead of being purchased on January 1st of the year, was purchased on April 1st of the year? We're going to do it the exact same way, except instead of taking the whole year of depreciation at 20%, we're only going to take 9/12, or 9 months out of 12 months of the depreciation the first year. Then over the next 4 years, 1, 2, 3, 4, we're going to take the 20%. But in the last year, we're going to take that portion, the remaining 3 months we didn't take in the first year. So if we purchase this asset on April 1st instead of January 1st, our depreciation for the year would be $1,800 instead of our $2,400. Now let's look at declining balance. It's accelerated at the beginning, and as the years go on, we decrease the annual depreciation. It basically doubles the straight line rate. So let's look at how this method works. The beginning book value is $13,000. The declining balance rate, we take 40%. You know how the straight line rate was 20? We're going to take 40%. So we take $5,200 as an expense. Now we have a book value of $7,800. So then we start the year with a book value of 78 times 40%. Now we take depreciation of $3,100. From there, we start the next year with $4,680 as the adjusted basis. At 40%, we're at $1,872. Do you see how it gets smaller? We start out with a big bang, and then because the adjusted basis is reducing faster, we're going to reduce our depreciation over time. That is the declining balance method. Okay?
I have a question.
Yes.
It doesn't apply too much to this. Like, you'll say like there's 3 different methods, but sometimes only one will be approved by the GA through the GAAP. I'm kind of confused on that.
Well, you can use depreciation methods which best suits your situation. So there may be times that it is more appropriate to use the declining balance method because the asset's going to wear out much greater. I'm going to give you an example. Let's say I purchase a new computer. Okay? Now, it might not necessarily, in the case of useful life, it's probably the ability to depreciate it faster in year 1, 2, and 3 is probably appropriate because in year 4 it's probably going to be worthless anyway. Okay? And maybe in that situation I just depreciate it over 3 years instead of 5 years too. But there are times where heavy usage up front based on the type of equipment it is. I'll have to, you know what we'll do, guys? Let's look at an example real quick of what kind of equipment is best utilized to use the double declining method. Assets best to use double declining method of depreciation. Why would a company use this? Most companies will not use double declining. The reason it causes the company's net income in the earlier years of an asset's life to be lower than it would under the straight line. One reason for using it is to have a consistent combination of depreciation expense and repairs and maintenance expense during the life of the asset. In other words, in the early years of the asset's life, when the repairs and maintenance are low, the depreciation expense is going to be high. In the later years of the asset's life, when the repairs and maintenance expenses are high, the depreciation will be low. That doesn't give me an example of an asset. Example of assets. Assets to use double declining method. you to find out this weekend which assets are best for using double declining. It's always great to have a little bit of information, isn't it, guys? Okay, guys, so we went through this double declining method, and one thing I want to show you, in the last year, do you see how 40% of 1685 is actually greater than 685, but what's the salvage value? Since the salvage value is $1,000, we're only going to take 685 as the depreciation in the last period. Units of activity is basically utilized for assets where the estimated useful life is generally related to how many can be pumped out. Tractors are a good example, or heavy maintenance equipment usually last in terms of hours, okay? Or certain trucks will last in terms of mileage. And so we can do units of activity based on what we believe the longevity in hours or longevity in miles of an asset may be. So in this case, if this asset we anticipate to go 100,000 miles, we calculate the cost per mile. So if in the first year we went 15,000 miles, we can calculate the cost per mile times that number of miles to come up with our annual depreciation. So 15,000 hours or miles based on 12 cents give us our first year's depreciation. In the next year, we had 30,000 hours. We're going to use that amount. 20,000 hours, 25, and 10. So do you see that's based on breaking it down per hour, per mile, per unit? Okay, these three different methods really play out differently on the financial statements, on the income statement, and on the balance sheet. Straight line method is the red line. Do you see how it's consistent in the same amount year after year? On the other hand, our double declining balance method starts extremely high and then ends very low. So the depreciation method is much greater and then slowly intersects here in year 2.5 and then continues to go down. Where the units of activity method is going to totally vary based on the activity. The IRS does not require taxpayers to use the same depreciation method on the tax return that it uses on the financial statements. The IRS requires either a straight line method or MAKERS, a modified accelerated cost recovery system. I always call it MAKERS. MAKERS is not acceptable though for GAAP. It's only acceptable for the IRS purpose. Here's a good example. Southwest Airlines has notes to the financial statement. Depreciation is provided by the straight line method to estimated residual values over periods ranging from 20 to 25 years for flight equipment and 5 to 30 years for ground property and equipment once the asset's placed in service. Amortization of property under capital leases is on the straight line basis over the lease term and is included as a depreciation expense. So this is a disclosure on the financial statements explaining the methods they use for their various assets. Sometimes our depreciation needs to be revised because we've discovered it's not going to last as long as we thought, or it might be able to last longer. So what we're going to do in revising it is we're going to kind of change the estimate. We're not going to go back and fix it from prior years. We're going to go forward and change it now. Here's an example. Arcadia High School purchased equipment for $510,000, which was estimated to have a useful life of 10 years with a salvage value of $10,000 at the end of that time. Depreciation has been recorded for 7 years on a straight line basis. In 2014, year 8 of 10 years, it's determined the total estimated useful life should be 15 years, with a salvage value at $5,000 at the end of that time. So we started out equipment of 510, salvage value of 10 over 10 years. Then in year 8, we determined, wow, this isn't going to last us 10 years. This is going to last us 15 years. We're going to be able to get 5,000 out of it at the end of the time, not 10. So how are we going to do it? To correct previous year's journal depreciation, we're not going back. We're just going to change it as of now. So what we'll do in order to determine how it's going to be changed, the salvage value was 10,000. So we were going to take 500,000 over 10 years. In 7 years, we've taken 350,000. Okay? So as of the end of the 7th year, we have a book value of 160 sitting on the books. Now, we think the new value is going to be 5,000 salvage value. So we're going to take the remaining adjusted basis and divide that over 8 years. 2 additional years plus the new 7, 8, 9, 10. 3 additional years plus the 5 years that make it 15. And from there, we're going to come up with our new depreciation. So starting in year 8 through year 15, we've got a new depreciation amount of $19,375 instead of the $50,000 we were previously using. We didn't go back, we're going forward with a new number. Expenditures during the useful life. You're still going to have certain things that don't get added to the value of the asset. You're going to expense them. Ordinary repairs are going to be expensed in the current period. But things that really help make an asset last longer than its current period is going to be added to the building as a capital improvement. Costs incurred to increase either efficiency, productive capacity, or useful life are going to be debited to the plant at the asset to increase the value. Bernie Ebbers, who was the founder and CEO of the phone company WorldCom, engaged in a series of increasingly large debt-financed acquisitions of other companies. These acquisitions made the company grow quickly, which made the stock price increase dramatically. However, because the acquired companies all had different accounting systems, WorldCom's financial records were a mess. When WorldCom's performance started to flatten out, Bernie coerced WorldCom's accountants to engage in a number of fraudulent activities to make net income look better than it really was, and thus prop up the stock price. One of these frauds involved treating $7 billion of line costs, which were really a rent, as a capital expenditure. The line costs, which were rental fees paid to other phone companies to use their phones lines, had always been properly expensed in previous years. Capitalization delayed expense recognition to future periods and boosted current profits. He got in a lot of trouble for that, didn't he? It was really an expense, but he tried to show it as an asset on the books. Impairments. Sometimes there's a decline in the fair market value, and so we need to write that asset down to the lower of cost or fair market value when something like that might happen. Okay, I think we're going to, let's go over a couple problems here. How are you guys doing?